Macroeconomic Update, May 2020. The month of May 2020 was a mixed month for the capital markets. Indian equities fell in the first half as the announced economic package fell short of market expectations, but largely recovered in the second half on back of optimism around relaxation of lockdown globally, including India. On the other hand, fixed income markets stabilized, with RBI reducing repo rate by 40 basis points. And as redemption pressure in credit-oriented schemes of mutual funds, which rose sharply in the last month, subsided. However, spread of COVID-19 continued to remain a concern, with number of infected cases globally rising to approximately 6.3 million as on end May 2020 from 3.3 million a month ago. In India, though the number of positive cases continues to rise, absolute number of cases were relatively low considering the large population. The total infected cases in India crossed 190,000 by end May, up from approximately 35,000 cases a month ago. With an ambition of self-reliant India, central government announced economic package to counter the slowdown due to COVID-19 and simultaneously introduce reforms for various sectors. The measures were focused on providing support to MSMEs and vulnerable sections of society, like poor, migrant laborers, etc., improving farm infrastructure, deregulating agriculture sector to a certain extent, supporting NBFCs, improving financial health of power distribution companies, encouraging domestic manufacturing, etc. Fiscal impact of these measures is likely to be limited. India's Q4 FY20 GDP growth moderated to 3.1% year-on-year from 4.1% in the last quarter. The slowdown was driven by weak private consumption, contraction in investments, partly offset by stable growth in government consumption. Contraction in manufacturing segment and soft growth in services resulted in GVA growth moderating to 3% in Q4 FY20. In FY21, GDP growth is likely to contract sharply on account of lockdown, but is also likely to rebound sharply in FY22 on back of absence of lockdown, pent-up demand, and low base. However, these 2 years should be viewed as aberration, and growth trajectory is expected to normalize FY23 onwards. Significant shortfall in tax revenues, especially direct taxes, resulted in centre's fiscal deficit in FY20 rising to 4.6% of GDP, as against revised estimate of 3.8%. This was partly due to extension of the tax dispute settlement scheme till 30th June 2020 and no curtailment in expenditures. Fiscal deficit in FY21 is likely to be significantly higher on back of contraction in fiscal revenues because of weakness in economic activity and likely impact of announced fiscal stimulus. IIP contracted sharply by 16.7% in March 2020, despite only 7 days of the month being impacted due to nationwide lockdown. This was driven by broad-based fall in all sub-segments led by capital goods, infrastructure goods, and consumer durables. Impact of lockdown and slow resumption of production is likely to keep IIP under pressure in the near term. Due to difficulty in data collection and limited number of transactions, full data related to CPI was not released for April 2020. However, data of some subcomponents, mainly consisting of food, housing, and health, etc., was published. The limited data suggests that there was broad-based pickup in food inflation. This could be partly due to supply disruption and hoarding up by consumers during the lockdown. Supply-side disruption can keep CPI at elevated in near term, but it should moderate in H2 FY21 on account of base effect and easing of supply restrictions. India's trade deficit for April 2020 improved due to lower net oil imports on back of sharp correction in oil prices and lower net gold imports. Excluding oil and gold, the trade deficit increased as lower imports of electronic goods was more than offset by weaker exports of engineering goods and chemicals. In May 2020, INR depreciated by approximately 0.7% against USD and closed at 75.6. Trade deficit is likely to improve in FY21 due to low crude oil prices, weak gold volumes, and likely fall in non-oil, non-gold imports. This is likely to be partially offset by weaker exports and lower remittances from abroad. Commodity prices ended the month higher on back of optimism around recovery in economic activity as major countries started easing restrictions. Lockdown and its impact is likely to result in India's GDP contracting in FY21, a first in the past 40 years. However, growth rate should recover in the second half of FY21 as the situation normalizes. Fiscal and monetary measures announced should also provide impetus to growth to a certain extent. Also, growth rate in FY22 is likely to be significantly higher due to low base and absence of disruption caused by lockdown. While immediate impact of disruption is negative, but once the situation stabilizes, India stands to benefit in the medium term, in our opinion. Amongst the emerging markets, India is better placed as most major EM economies have high dependence on global merchandise trade and/or are net oil exporters. Thus, weakness in global growth and fall in oil prices are likely to hurt these economies significantly. But India is a net importer of oil and stands to gain significantly due to fall in oil prices. Further, India's dependence on exports is relatively limited as compared to other EMs. Thus, once the situation stabilizes, India could see relatively stronger recovery. Further, disruption in global supply chain caused by this event has highlighted risk of overdependence on a single country. Thus, over the medium to long term, many global MNCs are likely to consider diversifying their manufacturing operations from China. India could be a likely beneficiary given the low corporate tax rate, skilled population, relatively low wages, and a large domestic market. For more on this, please refer HDFC MF Yearbook 2020, published in January 2020 and available on our website www.hdfcfund.com. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.